In 2008, the Federal Reserve created $1.2 trillion in a single month. Not by printing bills, not by borrowing from China. They just created it. Typed numbers into a computer system, and suddenly that money existed. And here's the part nobody wants to say out loud. They never destroyed it. That money is still out there, circulating through the economy, sitting on bank balance sheets, propping up asset prices. And the truly strange thing, they're probably going to do it again. Most people think government money works like household money. Tax revenue comes in, spending goes out, and if there's a gap, someone has to lend you the difference. That's the story we tell ourselves because it feels logical, responsible, real. But when governments actually run out of money, when the crisis hits and the bills come due, something different happens. Something that sounds like fiction, but shows up in central bank ledgers every time the system cracks. And once you see how it works, you start noticing it everywhere. In 2008, in 2020, in the quiet expansions nobody talks about between the crashes. The question isn't whether governments can create money when they need it. They can. They do. The question is, what happens after? Let's start with what doesn't happen. The government doesn't call up wealthy countries and beg for loans. They don't raid Fort Knox. They don't fire up printing presses in a basement somewhere, though that's the image everyone has. What actually happens is more abstract and somehow more unsettling. The central bank, let's say the Federal Reserve, buys government bonds, not with money they already have, with money they create in that moment. They add a number to the Treasury's account. The Treasury spends it, and now that money is real. It flows into paychecks, into bank accounts, into the stock market, into mortgage payments. This is called quantitative easing, though the term is deliberately boring. It's designed to sound technical and safe. But strip away the jargon, and here's what it is. The government creates its own demand for its own debt using money that didn't exist 30 seconds earlier. In 2008 alone, the Fed expanded its balance sheet by over $1 trillion. By 2014, it was nearly $4.5 trillion. By the end of 2020, almost $9 trillion. These aren't loans that get repaid. This is expansion, permanent expansion. And the really wild part? Most of it worked. Markets stabilized, banks didn't collapse, the system kept running. But here's where the logic starts to bend. If governments can create money whenever they truly need it, why do we worry about deficits? Why does anyone pay taxes? Why does the word bankruptcy even apply to a country that controls its own currency? The answer is inflation. That's the boundary. That's the invisible wall. You can create as much money as you want, right up until people stop believing in its value. And once that belief cracks, the whole system can unravel faster than any stimulus package can prop it up. Look at Turkey. Erdogan spent years insisting that high interest rates cause inflation, which is backwards. He pressured the central bank to print more, keep rates low, stimulate growth. And for a while, it looked fine. Then the currency collapsed. Inflation hit 85%. Savings evaporated. Or Argentina, where the central bank printed so much money to cover government spending that inflation reached 143% in 2023. A loaf of bread cost more every single week. The constraint isn't some hard rule written into the Constitution. It's trust. It's whether people still believe the money in their pocket will be worth something tomorrow.
And this is where the modern narrative gets strange. For decades, we were told deficits are dangerous, austerity is responsible, governments must live within their means. Then 2008 happened, and suddenly the rules changed. Central banks created trillions, and inflation stayed low. Economists started talking about modern monetary theory, this idea that governments with their own currency can't really go broke, that the only limit is inflation, not debt. For a while, that looked true. The US ran massive deficits. Japan printed money for 30 years. Europe launched negative interest rates, and inflation stayed dormant. Until it didn't. In 2021, inflation spiked. Suddenly, the money creation that seemed costless had a price tag after all. The debate flipped overnight. Central banks scrambled to raise rates, destroy liquidity, reverse the expansion. But the money they'd already created? Still out there. So what does this mean for the next crisis? Because there will be one. There always is. It means governments have a tool that feels like a cheat code. They can create money, stabilize markets, prevent collapse. But every time they use it, they're making a bet. A bet that inflation stays low. A bet that trust holds. A bet that this time the consequences won't catch up. And the historical record here is unnerving. Every empire that debased its currency eventually paid for it. Rome clipped coins until the denarius was worthless. Weimar Germany printed until people needed wheelbarrows of cash for bread. Zimbabwe printed trillion-dollar notes that couldn't buy a loaf of anything. The modern system is more sophisticated. The mechanisms are digital, the controls more precise, but the underlying gamble is the same. You're creating claims on future value and hoping that future arrives as promised. Here's the thing nobody wants to admit. We don't actually know where the line is. We don't know how much money can be created before trust breaks. And we won't know until we cross it. The Federal Reserve's balance sheet is still sitting at over $7 trillion. Japan's central bank owns nearly half of all Japanese government bonds. The European Central Bank holds trillions in sovereign debt. That money came from nowhere. And the uncomfortable truth is, when the next crisis hits, they'll probably create more. Because they can. Because the alternative is collapse. The only question left is whether we'll still believe in the value of what they create. And by the time we have that answer, it might already be too late.